Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 21st of May 2021 and we're publishing a slightly off-piste video on how the COVID-19 pandemic has tended to benefit the larger firms, and in spite of former President Donald Trump's arraignment against China, we can see that China has appeared to be a significant beneficiary, increasing its economic might via increasing percentages of major Chinese companies entering the top global 50 of major corporations. So let's take a look. Now, before we talk about this issue, just a brief reminder of 3 videos produced earlier this week. Gold and silver price optimism at last, gold and silver begin to surge, will it continue? And 7 reasons why gold prices could surge and soon. And we've listed these in the description box below for ease of access. Okay, coming back to today. We often hear in the headlines that big firms are getting bigger. The world economy is governed by 50 to 100 major corporations, and their tax avoidance schemes present an unfair playing field, especially when compared with new startup and much smaller businesses. Well, a study carried out by Bloomberg Economics seems to support this case, with a shift of top 50 companies' dominance moving from traditional industries towards high-tech, and China gaining an increasing share of such companies at the expense particularly of Europe, with the United States still managing to dominate. Now, rather than attempt to summarize this Bloomberg report, we thought we would read it in its entirety, as it contains a number of interesting factors. It also supports to some extent our view that this shift is likely to continue, with new high-tech and shortly AI industries, artificial intelligence industries, being where the wealth and future prosperity lies. And we have to consider potentially the effect of this on investments, not forgetting the ongoing battle between precious metals and cryptocurrencies or other forms of digital assets. So let's look at this article. Bloomberg article dated 21st of May 2021. Headline: World-dominating superstar firms get bigger, techier, and more Chinese. A trawl through 30 years of data traces the evolution of superstar firms, a difficult-to-tame species. The world's biggest businesses were doing fine until COVID-19 arrived. Now they're doing even better. The top 50 companies by value added $4.5 trillion of stock market capitalization in 2020, taking their combined worth to about 28% of global gross domestic product. 3 decades ago, the equivalent figure was less than 5%. Big gets bigger. Market cap for top 50 firms equals 28% of global GDP, as you can see in this chart. That's just one measure of how superstar firms have come to dominate the world economy, according to a new study by Bloomberg Economics that maps out their changing role. The findings provide ammunition for policymakers bent on reining in the giants, including a US government that's seeking to rally global support for higher levies on corporate profits. The biggest companies generally post fatter margins and pay less in taxes than they did in decades past, the Bloomberg Economic study shows. Their median effective tax rate of 35% in 1990 had dwindled to only 17% last year, while profit margins headed in the opposite direction, soaring from 7% to 18% over the same period. They also devote a smaller portion of their earnings to job-creating investments. In 1990, IBM, at the time the world's biggest publicly listed company, devoted 9% of its revenue to capital expenditures. Fast forward to 2020, when Apple, its replacement in the top spot, spent just 3%. And you can see in this chart, the median tax rate for the top 50 firms has slumped, looking at 35% to 31 to 24 to 17.4. The advantages superstar firms enjoy became all the more glaring during the pandemic, which is one reason why the issue of how to tame them has vaulted up the political agenda in so many countries. Tech giants such as Amazon.com Inc. have business models that are tailor-made for a year of social distancing, unlike Main Street competitors dependent on foot traffic. And government rescues worked best for the biggest companies, which benefited from central bank backstops that kept borrowing costs low and stock prices high. In contrast, patchwork relief efforts for small businesses left many struggling to pay their bills. In the United States, President Joe Biden's administration is seeking to raise corporate taxes as part of a wider effort to halt the long drift to inequality. He wants to reverse at least some of the cuts implemented by his direct predecessor Donald Trump. He's also pushing for a global tax deal that would make it harder for the biggest companies to lower their bills by shifting profits to low-tax jurisdictions. That practice spread as corporations grew bigger. A 2019 study by the International Monetary Fund found that as much as 40% of what on paper looks like foreign direct investment is phantom investment into corporate shells with no substance and no real links to the local economy. In a speech in April, Treasury Secretary Janet Yellen cited a global 30-year race to the bottom on corporate tax rates. She said agreement among a group of 20 countries on a global minimum charge will create a more level playing field in the taxation of multinational corporations. The United States' push has drawn resistance from nations such as Ireland, whose low corporate tax rate has encouraged multinationals, including Apple Inc. and Google owner Alphabet Inc., to set up regional headquarters there. After initial signs, the US might want a 21% minimum rate. The Biden administration has now proposed 15%, a sign of the compromises required to achieve consensus on a contentious issue. In 1990, there were no Chinese businesses among the top 50 exchange-traded companies. Last year, there were 8. China's gains have come largely at the expense of European enterprises, whose presence on the list has shrunk from 15 to 7 over the period. Now, as you can see here in black on this chart, that they represent US firms, purple China, yellow EMEA. These are the key ones, so you can see US 1990, 30, 2030, 2010, 25, but 2020, 32. But look at what's happened to the EMEA and China. EMEA 15, 16, 11, 7. China virtually not counting, to 7 to 8. Alongside the shifting geography of the world economy, the Bloomberg economic study also captures a profound change in what the biggest companies do. Technology dominates the top of the list, and fossil fuel companies, with the exception of Saudi Arabia's flagship Aramco, have dropped off. The extraordinary growth of tech companies in particular is what's spurring government action. They're in the crosshairs of politicians and regulators almost everywhere. That includes China, where regulators blocked a proposed initial public offering by Jack Ma's Ant Group, slapped record fines on affiliates including Alibaba Group Holdings, and have extended the crackdown to other tech giants like Tencent Holdings. And as you can see in this chart, technology firms account for 21 of the top 50 spots. Europe has been working on ways to tax companies such as Amazon and Alphabet based on where they operate, rather than where they're based. The idea led to tension with the US under Trump, but with the Biden team in place, there's hope for a deal. In the US, there's bipartisan support for a tougher approach to big tech that goes far beyond tax rates. It's one area where Biden looks set to stick with the policies of his predecessor. The president has nominated Lina Khan, a Columbia Law School professor, and author of a landmark paper accusing Amazon of monopolistic behaviour, to a key job on the Federal Trade Commission. The FTC is already seeking to break up Facebook Inc. in a lawsuit begun under Trump, and the Department of Justice has filed a monopoly case against Alphabet. Amazon has built its dominance through aggressively pursuing growth at the expense of profits, a strategy that the economics of internet platform markets encourage. Khan wrote in 2017, "Under these conditions, predatory pricing becomes highly rational. For his economic counsel, Biden has tapped Tim Wu, another Columbia law professor whose 2018 book, The Curse of Bigness, calls for more aggressive use of antitrust law." The growing interest in that agenda has drawn comparisons with the classical age of US trust-busting more than a century ago, when politicians led by Theodore Roosevelt broke up monopolies in oil, railroads and other industries and subjected the corporate titans of the day to tougher regulation. Back then, as today, politicians from both parties worried that corporate wealth and power had become concentrated to a degree that was anti-democratic, and that a failure to halt the trend might open the way to more radical and populist demands in a society riven by wealth inequalities and a sharp urban-rural divide. Many of the concerns driving governments are specific to tech and its growing influence in all areas of life, including free speech and the vast amounts of personal data companies accumulate. But others relate to bigness in general, which creates market power, the ability to stifle competitors, strong-arm suppliers, milk customers, and shape regulation. There's also a growing body of research showing that increased dominance of superstar firms has placed workers at a disadvantage. Many economists have attributed the slow US wage growth of the pre-pandemic decades, at least in part, to waning competition. Some tech companies have business models that allow them to scale up without adding many staff. Others, Amazon and Alibaba among them, employ huge numbers of workers, but often in low-skill and low-paid jobs, though Amazon, after defeating an attempt to form a union at an Alabama warehouse, has announced pay increases across the board. Another measure of the growing might of superstar firms is the increased profit margins that Bloomberg Economics documented, which would likely be even wider if some companies weren't sacrificing short-term income for gains in market share that will deliver larger payoffs in the years ahead. Economists studying the problem of bigness have concluded it shows up at levels below the world's top 52. For example, a 2018 study found that 3/4 of US industries saw an increase in concentration over the previous 2 decades, with the market dominated by fewer and bigger companies. With fat profits, light tax bills and limited need for capital or even workers, the new generation of mega firms poses challenges for monetary and fiscal policy too. The supply-side argument that lower taxes spur growth by fueling hiring and investment, never particularly well supported by the data, now looks even more tenuous. And the idea that central banks can achieve the same effect with lower interest rates takes a hit when the mega corporations have amassed so much cash they don't need to borrow. In 2020, the top 50 companies were sitting on a cash pile of $1.8 trillion, enough to fund their entire capital spending for the year more than 5 times over. Amid all the concerns triggered by the emergence of superstar firms, the Bloomberg Economics study offers one finding that may be more reassuring. In each of the last 3 decades, about half of the top 50 spots in the corporate rankings have turned over. And you can see that in this chart here. The purple showing new top 20 members and the grey old members. The rise of China, advances in technology and the clean energy revolution are driving turnover at the top of the global corporate rankings. That doesn't necessarily say much about the prospects for newcomers trying to break into an industry. It may merely reflect an economy's changing contours, such as the generational shift from big oil to big tech. But it does show that market dynamism is still at work, and that getting to the top is no guarantee of staying there. End of article. Well, admittedly it was quite a long article, and we apologise for that. But do you agree with the author's scenario conclusions summary? How do you see these panning out for the future? The one area we certainly drew from this, and other studies we've seen, is that long term, it will be highly unlikely that we shall have full employment again. And as technology improves, fewer and fewer lower grade jobs will become available as AI and robotics take over. What effect this will have on normal people's purchasing power, we shall have to wait and see. But in order to avoid global unrest, some form of substitute has to be found where people can still maintain at least a minimum standard of living. And where that lies, as yet, no one really knows, and is hoping that the green environment and new technology can create additional jobs. We, to be frank, are not convinced it will be enough to replace the more manual labour type activities that are currently being adopted, and which will be lost under a new high-tech regime. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel. Not forgetting to press the bell sign so you're notified of our videos as and when they are published. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.